I guess, Bill, congratulations on retirement. I want to get to the track record, the challenges you've had at Janus Henderson. But how did you get here? How was this decision made in the last number of days? Did you make this unilaterally? Did you make this with Janus Henderson management?
Well, no, I did it unilaterally and in combination with my family and my partner, Amy Schwartz, who I'm having so much fun with. You know, it's been almost a half a century of watching screens, Tom, and waking up in the middle of the night to check Asia and Europe, and then Tom Brady equivalent years. That's a long time. I've got a few Super Bowl rings along the way to look at, and it's time to enjoy myself and enjoy my family.
Within this is the catalyst of outflows of funds. Was it harder to manage the Janus Unconstrained Fund given the repeated and chronic outflows that you've seen over the last number of quarters and even years?
Well, not really. I mean, half of the fund is mine, and I haven't taken any money out of the fund. Others have, as you've mentioned. I look back on it, and the performance on the unconstrained fund in the past 4 years with Janus has been unsatisfactory, no doubt, but still positively positive in normal and nominal terms. What I'd like to mention, though, is I've managed some total return accounts, what I'm famous for Janus, and they've outperformed like the old days at PIMCO, 100 basis points over, and actually outperformed PIMCO. So maybe I should have stuck to total return and been a little more constrained. This
is a really important point, folks, and that Mr. Gross has a number of ideas going here, including fighting the fixed income battles, the fixed income wars of mutual funds. But I was talking with our John Gittleson in Los Angeles, Bill, and within the unconstrained model, the prospectus model of this phrase unconstrained, what did you learn about the pros and cons, the difficulties of this phrase unconstrained?
Well, unconstrained has come to mean basically go anywhere. You know, the total return concept that I developed was really developed on a concept of measured risk taking. It's what I learned in the days of blackjack. You didn't put a lot on the table. And so, you know, for the past 3 or 4 years, the negative trade for unconstrained has always been Germany versus the United States in terms of a spread. 10-year German bonds started out in my portfolio at 190 basis points over, and they're now 250 plus over. And so that's been it's been the big decider, and probably one in which I shouldn't put too many chips on the table.
Well, this is critical, Bill, and this goes to the hedge funds and so many underperformances of hedge funds, depending on whatever you want to look at with the statistics. Was the underperformance that you faced in the last year with unconstrained, was it because you were not diversified? Is it the phrase unconstrained gets you into a focus where the bets are too big, to go back to Ed Thorpe?
Yeah, I think it did for me, and perhaps for other unconstrained funds too, if only by the nature of the term. You know, the old Ed Thorpe terms, the gambler's ruin concept basically said you could only bet 2% of your total capital, and certainly I had positions in unconstrained that were significantly more than that, especially the German-U.S. Treasury trade, and that probably was too much. But it was an unconstrained portfolio. Investors were expecting hedge fund types of returns of 5 to 10%. Well, and, for a while there, it was only 1 to 2%, and that was unsatisfactory.
It was unsatisfactory, and Bill, this goes to your perspective now, and we should point out that Mr. Gross has written all sorts of academic work for the CFA Institute over the years on finance, on the integrity of financial theory. You've lived it, Bill. Is the hedge fund model broken because it's a non-diversified model?
Well, I think it was broken for a long time, Tom. You know, obviously the hedge fund concept suggested long and short, but it was really one in which managers took a lot of risk.
Yes.
And so when you speak to diversification, perhaps most of those hedge funds were non-diversified in terms of the risk that they were taking. They were taking levered risk and still are. And so to the extent that markets move in an risk-off type of mode, and they have in December and other periods of time, then the hedge fund concept is really an exposure of risk as opposed to anything else, and it needs to be more diversified for sure.